If you're a homeowner and you want to pass your home to your heirs, then you need to do it the right way. Your heirs could either pay $0 in capital gains taxes or hundreds of thousands of dollars when you pass down your home to them. It all depends on you. So today I'm going to explain everything that you need to know about passing your home down to your children in the most tax-advantaged way possible. Without further ado, let's dive in. All right, guys, let's talk about homeowners' dilemma. As many homeowners reach retirement age, they start to think about what they are going to do with their homes. And a lot of them want to pass their homes to their children after they die. Others want to give their homes to other relatives or friends. But homeowners face major decisions when they reach this point. They can either give their homes to their heirs before they die, or they can give their homes to their heirs after they die. So for a lot of people, the natural instinct is to pass the property off to their heirs before they die. This seems like kind gesture, if you will, right? You get to see your heirs enjoy it and feels like you're helping them out early. Many people also think that transferring the home before their death will give them greater sense of peace because they know they won't be leaving the complicated property transfers to their heirs after they die. But this choice can lead to big tax problems for your heirs because of an extremely important tax code provision called step up in basis. If you do not know what step up in basis is, then pay close attention because this is what could literally make the difference between your heirs paying hundreds of thousands of dollars in taxes or $0 in taxes when it comes to the property they will inherit from you. So, what is step up in basis? To understand what step up in basis is, you first need to understand what basis is. Basis refers to your cost basis. Kind of confusing, but follow me. The cost basis of the property is what you originally paid for. If you bought a home for $100,000 20 years ago, your basis is $100,000. Now, when you sell a property, the government taxes you on the profit, which is called capital gain. The capital gain is the difference between what you sell the house for and your cost basis. If you sell the house for $300,000, your capital gain is $200,000. You would owe capital gains taxes on $200,000. Now, here's where the step up in basis comes in. When you die and you leave a property to your heirs, the basis of the property gets stepped up. What it means, the basis where you're at $100,000 is going to be stepped up to the current market value at the time of your death. This means your heirs don't use your original cost basis of $100,000, but instead, the basis becomes whatever the house is worth when you die. If the house is worth $300,000 at your death, their new basis is $300,000. If they sell it right away for $300,000, there's no capital gains tax. Their capital gain tax is $0. But, and here's the crucial thing, if you give the house to your heirs while you're alive, they take it on your original basis, which would be $100,000. If they sell it later for $300,000, they have a capital gain of $200,000 and they'll owe taxes on that amount. The federal capital gains taxes alone on this gain would be roughly $40,000. That is before you factor in any state capital gains taxes And that is why passing a home before the death can be a massive mistake for some people. $1 million home before death versus after death is going to be a great example for us to go over next. Let's walk through another clear example to show the tax differences between passing a home to your heirs before and after the death. Sarah bought her home 30 years ago for $100,000. Today, it's worth $1 million. Her son Jake plans to sell it soon after he receives it. We'll assume a capital gain tax rate is $20,000 for this example. Sarah decides to give the house to Jake while she's alive. Jake takes the original basis of $100,000. A few months later, Jake sells the house for $1 million. Sale price is $1 million. Basis $100,000. Capital gains are $900,000. Capital gains tax is $180,000. Jake would owe whopping $180,000 in federal capital gain taxes. He could owe thousands more in state capital gains taxes. In these circumstances, Sarah accidentally settled her son nearly $200,000 in capital gains taxes that could have easily been avoided. Now, let's say Sarah keeps the home until she passes away. Jake inherits it through her will. At the time of her death, the house is still worth $1 million. Because of the step up in basis, Jake's new basis will be $1 million. If he sells it for $1 million, his capital gains tax bill is $0. Another thing to consider here is that Jake would also not owe any estate taxes on the inherited property. Estate tax exemption in 2025 for someone single is $13,000.9 million. Sarah cared deeply about her son. Instead of forcing him to deal with a massive tax bill on top of the grief of losing his mother, she took the time to learn how to optimize his tax savings for property transfers. This gave him almost $200,000 of extra money that he will get to keep and use it to build a better life for himself and maybe his family. This was Sarah's last gift to her son. You might ask, Ina, what about rental properties? And yes, step up in basis applies to rental properties in addition to primary residence. So, you can also save your heirs a fortune in taxes just by passing rental properties to them after your death as well. In most cases, it's going to be significantly more advantageous just to keep the home in your name and let your heirs inherit it after you die. Here are some simple steps to make this work. Make a will or a trust and talk to a tax professional. Every family situation is different. Consider assets you might want to give during your lifetime, such as cash or lower tax items. Passing a home to your heirs before you die might seem like the right choice at first, but it can lead to a big tax bill because your heirs miss out on step up in basis. Keeping the home until you die gives more control and avoids other risks like family disputes. By planning ahead with a will or a trust and talking to a tax professional, you can make sure your heirs get the benefit with the least hassle possible and the least amount of taxes possible. That's all I've got for today's video, guys. As always, don't forget to like, comment, and subscribe. We're growing this channel and we're just doing everything we can to give you more information that will help you build a tax-free life. Thank you so much for tuning in, and I'll see you on the next video.